Good morning, I'm Clinton Griffiths. The Federal Reserve is announcing another rate hike. It comes amid the collapse of some high-profile banks and still high inflation.
At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%.
The decision representing the ninth rate hike since March of last year in an effort to keep inflation in check. AgDay's Michelle Rook joins us. And Michelle, there was a lot of uncertainty ahead of that announcement and the impact it would have.
Clinton, right after the last FOMC meeting, the market was already speculating that the Fed would raise rates 50 basis points in March. But then the banking crisis hit, and many experts believe that would cause the Fed to back off their efforts to curb inflation. In fact, going into the Fed meeting, the Fed fund rates were trading 90% odds of a 25 basis point hike in interest rates on Wednesday. The decision by the committee to raise rates 25 basis points puts the target range for the Fed funds rate to 4.75% to 5%. It signals the Federal Reserve is still on course to cool inflation down to reach their goal of 2%. However, the central bank took into consideration both the economy and the stability of the banking system, even though the inflation and other jobs data would argue for continued tightening.
And their focus is trying to get the economy settled down, and their way to do that is to make the interest rate adjustment. So they're taking their job seriously to try to do what they have to do to control the economy.
You support the banks, but at the same time you try to control consumer spending. So you put the pain really on the consumer rather than on the banks. And the way to do that is to continue to raise the interest rate, but also to continue to provide that liquidity to those banking institutions.
A quarter point increase was already expected, and so the hope is that the risk aversion in the markets will start to subside, especially longer term.
I think that will bring in a little bit of stability into the markets. We won't see, the dollar, I think, will then start to see a little bit of a retracement again. Gold will slow down its run. We won't be seeing the safe haven runs. And I think it'll help bring some stability into the cattle markets again, too, and help try to prop that market back up again as we continue to see extremely tight supplies.
Seifert says the Fed decision will set the tone for interest rate and monetary policy and the trajectory of the economy for the next 3, maybe even 6 months. Inflation is a problem worldwide, and in comparison, the UK clocked in this week with higher than expected inflation of 10.4%. However, even with the banking concerns in Europe, the European Central Bank raised rates 50 basis points.